Last lecture, we talked about treasury bills. We're going to talk about all the other types of money market instruments in this section. First of which will be certificates of deposit or CDs. Uh, the issuers of certificates of deposit have historically been depository institutions. However, what are called brokered CDs have become much more popular in recent years. Those are certificates of deposit issued by brokerage firms. So you could potentially buy a brokered CD from J.P. Morgan, Barclays, or any other number of institutions. These denominations can be any size. The 100,000 or more are typically marketable. The maturities vary. Again, could be up to a year, and with regard to money market instruments, the typically a minimum of 14 days. Liquidity is very high for CDs less than 3 months if they're marketable. The default risk, the first $250,000 issued by a bank that is insured by the FDIC would be insured. Interest type is add-on, which is different than the discount method. There'll be a face or a principal amount of the CD, and interest will be added to that amount. So you would receive your principal plus interest at maturity. They are taxable at every level, federal, state, and local. Figure 2.2 shows the spreads between CDs and treasury bills. As is the case with many other securities, the spreads widen out when there are financial difficulties. We start in 1970, and we see that the spreads are relatively low, 0.5% to 1.5% maximum. However, those spreads went up considerably when the OPEC crisis, the market crash you see in 1987, the 1998, it was a long-term capital management crisis, or crisis related to that company. And then we see in the financial crisis, those spreads widened out considerably more. So we'll see this with this type of spread widening anytime there's some sort of issue with the markets. There's going to be what we call a flight to quality. Treasury bills are going to become much more attractive because of the very, very low risk that we talked about when we talked about treasury bills. Commercial paper is the next instrument. I don't know why it says certificates of deposit there. It should say commercial paper here. Commercial paper is issued by very large, very highly rated corporations and financial institutions. Minimum denomination, $100,000. Maturity is 200, maximum of 270 days or 270 days or less. Usually they're 1 to 2 months. The liquidity, the commercial paper less than 3 months is very liquid if it's marketable. Default risk is typically very, very, very low. However, they are unsecured instruments, but again, we're talking about very highly rated corporations and financial institutions. The commercial paper is issued at a discount, like treasury bills, meaning that it will mature to its face value. You pay a price less than the face value when you purchase it. It is and it is taxable at the federal, state, and local level. A new type of commercial paper is asset-backed commercial paper. It would be tied to some sort of underlying asset. Other instruments, bankers' acceptances. The banker's acceptance, a purchaser authorizes a bank to pay a seller for goods at a later date. It's also referred to as a time draft. These are used for purchases of goods between two entities when those entities don't necessarily have a relationship. So the purchaser bank will accept the draft. It becomes a contingent liability of the bank, and it is marketable. Euro dollars are dollar-denominated time deposits held outside the U.S. They typically pay higher rates than U.S. deposit. The federal funds are trading in reserves held at the Federal Reserve. Federal funds rate is set by the Federal Reserve Bank. It's a key interest rate for the economy. If we've seen recently, the Federal Reserve has raised Fed funds rates considerably. Fed funds rates were almost zero for a considerable period of time after the financial crisis, and there's been concern in the economy over recent months because of interest rate increases. LIBOR is London Interbank Offer Rate. LIBOR is a very key rate because many financial instruments are priced off of LIBOR, derivatives, interest rate swaps, for example. The vast majority of them are based off of the LIBOR rate. It is the rate at which large banks in London and elsewhere lend to each other. Again, the base rate for many loans and derivatives. Repurchase agreement. Bank calls them RPs. I mean, the book calls them RPs. Most people I know would refer to them as repos. But anyway, it's one of the things that you see, seem to see a lot in finance. Authors that try to create, I don't know if we create new words or new names for things, but again, for the most part, repurchase agreements are referred to as repos. The repurchase agreement is a short-term sale of securities and a promise to repurchase those securities at back at a later date, typically at a higher price. There actually have been examples where, and not that long ago, where the repurchases were actually occasionally for negative interest rates. That is because certain treasuries become very popular for repurchase agreements. So the supply of those treasuries are limited. So there is occasionally an opportunity for them to be repurchase agreements be created at a negative interest rate. It's rare. A repo or repurchase agreement is a collateralized loan. So, many repurchase agreements are overnight. Repurchase agreements terms can have up to a 1 month maturity. Reverse repurchase agreements or repos, lending money and obtaining the security as collateral. So it's just effectively the other side of that trade. There certainly can be haircuts required depending on the type of security used. Brokers' calls. Brokers' calls, refer to the call money rate. We're dealing with investors buying stock on a margin. You can also sell or short stock on a margin as well. That that would be the same type of situation would be involved there as well. If the amount of equity declines to below a certain percentage, that loan can be called in by the broker, or the broker uh, can be forced to make up that difference.